Welcome to Taking Stock for the week ending the 29th of October 2021, where Jacob Simonsen, our Equities Analyst, and myself, Kien, Trinh, stream to you all things share market. Nice to see you take advantage of our new freedoms in Victoria with a haircut there, Jake.
Yeah, it certainly was a good feeling, Kien.
Well, the AGM season, the period where companies provide interim updates on their operations, is currently in full swing. And in general, our star stocks have been able to track in line with market expectations. And this comes despite concerns of cost pressures from higher commodity prices and supply chain constraints. And this theme has also resonated from another strong third quarter US reporting season where 84% of S&P 500 companies have met or beaten market expectations. And among the sectors, the companies with more international exposure and those in financials and technology have experienced the strongest positive earnings surprises. And this has supported both the US and Australian markets, which continue to trade close to highs.
Yeah, you touched on cost pressures, Kien, and one of the main events to come through this week has been inflation figures, which suggest underlying inflation has risen by 2.1% in the September quarter and within the RBA's 2 to 3% target band for the first time since 2015. Remember, this band represents the area which could instigate the RBA into raising interest rates to keep inflation intact. However, the RBA wants to see stronger wage growth and inflation rise towards the middle of the 2 to 3% target for at least 2 quarters before lifting interest rates and does not expect this to occur until 2024. However, the bond market and many analysts believe interest rates will rise sooner than expected, with some forecasting a rise next year in 2022. Meanwhile, globally, core inflation in the US is running at 3.6%, while in the UK, it is 2.9%.
Interesting, Jake, but why does this matter and should investors be concerned? Well, equity markets, as we've previously alluded to, equity markets are a function of interest rate expectations. Now, low interest rates are positive for the share market because there are limited returns outside of the equities market. So the money has to go somewhere. In other words, there is an opportunity cost of not investing in equities. And with low interest rates, super funds and money managers, they need to move up the investment risk curve to meet their return targets, creating increasing demand for equities and driving up share prices over time. Secondly, low interest rates leads to higher stock market valuations because the present value of future cash flows are discounted at the lower interest rates.
Yeah, but although the threat of rising inflation interest rates could cause market volatility, we believe this should represent opportunity for investors. Rising interest rates are not necessarily a bad thing, especially when interest rates are near zero. This is because rising interest rate or bond yields, which are expectations of forward interest rates, are a function of stronger economic growth. Expanding economic activity means companies will be generating higher revenue to offset the secondary impact of rising interest rates. In fact, as you can see from the scatter plot on screen, there is a positive correlation between bond yields and equity returns when interest rates are rising and remain below 5%. In other words, in a low and rising interest rate environment, equity markets tend to perform well.
That's right, Jake, and only when interest rates rise above 5% do we see a negative correlation to equity markets. And this makes sense intuitively because the risk of remaining in equities becomes less attractive when cash and bond yields are paying high rates of return. But interest rates are currently close to zero, so we are years away from this scenario if it ever occurs at all. Hence, it's important to make hay while the sun is shining. Now, earlier on in the video, we alluded to the AGM season, so let's now turn our attention to some star stock highlights. Last week, we spoke about Codan, a star growth stock specializing in metal detectors and communication equipment for the military and emergency services. We specifically highlighted the reasons for the share price weakness. And to recap, sentiment has soured on the stock due to the planned departure of CEO Don McKirk, and secondly, the withdrawal of US troops from Afghanistan, with its military devices contributing to about 2% of its group revenue.
Yeah, and this week, Codan announced a seemingly positive trading update with the company winning a communications contract that's set to boost FY22 revenue by 5%. Furthermore, the company's on track to meet full year growth guidance within the mid-teens. Yet the share price has fallen 26% since the announcement to Thursday's close. The share price volatility was driven by a military coup in Sudan, which we estimate metal detection sales make up roughly 10% of the company's FY21 revenue. For now, we have retained Codan as the star growth stock because we believe the share price has overreacted to the news, though we will continue to monitor developments in the next few weeks, especially with regards to earnings revisions and how this will impact Golden Rule 3, the outlook and active risks.
And speaking about deflating moments, Jake, the acquisition of star growth stock Smartgroup has also fallen off the table. And as a refresher, Smartgroup offers salary packaging and fleet management services to the defensive sectors in government, health and education. And the group received a takeover offer from private equity in late September for a price of $10.35. But after due diligence, the bid was revised to $9.25 per share, which was promptly rejected by the Smartgroup board.
Yeah, unfortunately, Kien, no reason was put forward for the lower offer, and this could be unsettling for investors. This does prompt us to be on high alert, but given the number of failed takeovers, particularly driven by private equity firms over the past couple of months, including EQT's failed bid for Iris, BGH's unsuccessful takeover of Hansen, and the termination of a deal between Altium and Autodesk, we don't believe that the revised offer is highlighting any skeletons in the closet.
Yeah, that's right. And in fact, Smartgroup has a history of transparency and has stated that is in line to deliver on consensus expectations with earnings growth of over 40% for FY21. Hence, we believe the share price setback may represent opportunity for investors with the potential for other suitors to come on board as well. Also now, among the supermarkets, Australia's major supermarket operators provided a trading update for the first quarter this week. Interestingly, Woolworths management were a little cautious that the lifting of lockdowns may cause a mean reversion in supermarket sales, citing slower performance in October to date. However, Coles management, they reported a continuation of low single-digit sales growth into the second half. We feel the difference in the outlook sentiment between the two companies is probably due to Woolworths' high single-digit growth of 8%, which will be harder to sustain as compared to Coles' low single-digit growth of 2%. The free cash flow forecasts for both supermarket operators are anticipated to remain well above dividends, although Coles is expected to pay a higher forward gross dividend yield at around 5% compared to Woolworths at 3.7%.
And this morning, Kien, just before filming, we had investment institution Macquarie Group reporting first half 22 net profit 6% ahead of market expectations, and they announced an interim dividend of $2.72 per share. In addition, the company announced that it would be undertaking a $1.5 billion capital raise or adding an additional 2.2% of shares on issue to help to continue to invest in opportunities, having deployed $5.5 billion into such opportunities over the past 12 months. Finally, consistent with prior periods, no immediate outlook statement has been provided, but consensus is anticipating earnings growth around 16% for the year ahead. Now, turning our attention to the week ahead, Westpac will be releasing their annual report on Monday, whilst Domino's Pizza, Waypoint REIT, Credit Corp, Aurelia Metals, and Integral Diagnostics will be hosting their AGMs. And for the trend-sensitive investors, Westgold Resources and BWP Trust turned bullish on the SD Max, while AUB Group, CSL Limited, and James Hardie issued bearish signals. No changes were observed on the SD30 TSR.
This week we put the spotlight on star income stock, ANZ Bank, following its full year result. It's the first major bank of the ranks and can help investors understand the corporate landscape, specifically around the impact of recent lockdowns in Victoria, New South Wales and Canberra. Positively, the bank remains in a strong financial position with its capital tier 1 ratio at 12.3%, well above APRA's requirement of 10.5% and relatively in line with its major peers. Cash earnings rose by 69%, and that was boosted by the release of over $500 million in provisions for bad debts as the economic outlook improves. This has also enabled the bank to pay a fully franked dividend of 72 cents per share for the second half, and that was slightly above market expectations of 70 cents. The better than expected dividend, coupled with an unstretched payout ratio of around 65%, implies that the dividend will not only be sustainable, but potentially be upgraded in FY22. The stock currently trades on a forward gross dividend yield of about 7%, and it is expected to go ex-dividend on the 9th of November.
Interesting, when compared to the other major banks, ANZ is trading on a more attractive dividend yield. Part of the reason for this is because ANZ has a higher cost base when compared to some of the other banks. Moreover, it has failed to capture market share of the home lending boom that's been observed over the past 12 months, with volumes in its home loan business falling behind its peers due to competitive pressures and also processing issues. Despite this, we believe the dividend yield of over 7% represents opportunity for investors, especially since ANZ aims to improve its processing times and expects its home loan growth rate to move in line with peers in the second half of this financial year. This should help the bank achieve positive earnings growth for the year ahead.
And for investors, the key difference between ANZ compared to the other banks is that it has a larger exposure to the New Zealand market and institutional lending, which makes up about 17% and 32% of its revenue, respectively. And although these segments allows diversity in its earnings profile, it can also lead to higher earnings risk due to the currency movements and also the earnings volatility associated with the institutional banking arm, such as the financing and advisory fees. Turning our attention to this inflation theme, a few of our investors have asked which star stocks tend to do well during an inflationary environment. This is quite useful if volatility rears its head, allowing us to look for opportunities within our high quality universe. The sectors that usually perform well lie in energy, property trusts, consumer staples, materials, financials, and those cyclical industrials. And this is shown on the chart on screen with the x-axis representing the probability of beating inflation. So that's the sectors that are beating inflation, and the y-axis representing the level of outperformance on top of inflation. Sectors closer to the top right quadrant tends to do better.
Yeah, we don't have exposure to energy stocks since many of these do not meet our Golden Rule 1, financial health, and Golden Rule 2, past financial performance criteria. However, within the real estate investment trust or REIT space, we have Charter Hall Social Infrastructure and Charter Hall Long WALE REIT. We have Arena, BWP Trust, Waypoint, and Rural Funds. REITs tend to do well because property and rents tend to increase with inflation. The caveat here is as long as interest rates do not rise by more than inflation, then debt costs should remain under control. In consumer staples, our star stocks include Woolworths and Coles, although others like Collins Food and Domino's Pizzas could also be included here.
That's right, and also among the financial sector, star stocks to consider include Pinnacle Investments, MA Financial Group, Smartgroup, Macmillan Shakespeare, Credit Corp, Perpetual, the ASX, and Suncorp as well. And talking about banks, for income investors, you can include Commonwealth Bank there, which is also currently a borderline star growth stock. And remember, rising interest rates, they tend to help banks expand on their net interest margins, which is the difference between the rates on their loans and deposits. Meanwhile, within materials, our star stocks include James Hardie, BHP, Oz Minerals, South32, BlueScope Steel, Sandfire Resources, and also Ares Resources as well. And these stocks are leveraged to economic growth, which tends to occur during periods of rising inflation.
Yeah, historically, gold tends to act as an inflation hedge and can outperform significantly, as can be seen on the chart on screen, although the probability of outperformance is not high. Our star growth stocks exposures here include Aurelia Metals, Alkane Resources, and Westgold Resources. Of course, there is Newcrest Mining in the borderline growth portfolio for those of you who would like a larger gold miner exposure.
Yeah, it's interesting, Jake, how gold has not really reacted to inflationary pressures so far, but this could change and could represent an opportunity for investors. Anyway, thanks, Jake, for your insights. I love your new look.
Thanks, Kien, and thank you for having me on.
So investors shouldn't fear an inflationary environment at this stage of the market cycle because it reflects the recovery in the economic environment following the COVID pandemic. Remember, interest rates are close to zero, and a lift in interest rates from here tends to be positively correlated to the share price movements. Hence, inflation should not be feared but embraced. It's important to separate the facts from the noise and continue to make hay while the sun is shining. Take care and have a happy, healthy, and prosperous week, everyone.